Good evening, all. On behalf of NISM, I warmly welcome to you all for today's webinar on Impact of Global Macroeconomic Trends on Indian Financial Markets. I am Neha Deshmukh, working with NISM. Joining us today are esteemed industry experts who will be leading the session. We are honored to have with us Mr. Joydeep Sen, corporate trainer and author. Before we begin, let me allow to give a quick introduction of our speaker. Mr. Joydeep worked in financial services industry for 25 years until 2016. For the last 13 years of those years, he was Senior Vice President at BNP Paribas Wealth Management, leading the advisory desk. Before that, he worked with different private sector companies. Since 2017, Sir has been following his passion. He regularly writes columns for various financial publications and has published 562 articles since January 2017 in outlets like Mint, Money Control, Financial Express, ET Market, Outlook Money, The Hindu, Business Line, and Cafe Mutual. He also appears on CNBC Mutual Fund show every few months. He has authored 4 books. First is Fixed Income Market in India, Investment Opportunities for You. Second one, Mutual Fund in India. Third one, Open for Your Eyes to Management Lesson Around Us. Fourth one, Wealth Management, a guide for middle income classes. And the Financial Planning and Wealth Management. He has done training for NISM, CRISIL, FPSB, CIEL, mutual funds, banks, NBFC, and content work for NISM. He is a visiting faculty at IMT Ghaziabad. Mr. Joydeep is a certified financial planner. He did his MBA from Jadavpur University, Kolkata. He has been awarded 100 Most Influential BFSI Leaders by BFSI Congress in Feb 2019 and Feb 2023. 50 most influential financial service market professional at the Financial Service Market Summit in November 2019, November 2021, November 2022, and most admired BFSI professional in February 2024. So once again, a warm welcome to Sir for today's webinar. Some important announcement for the participants. We will take all the questions at the end of the webinar. Please submit your queries at Q&A board. All the participants will receive participation certificate within 3 to 4 days. And the recording of this session will be available on NISM YouTube channel. So now, without delay, I would like to hand over this session to our speaker. Over to you, sir. Thank you.
Thank you, Neha. Thank you for the wonderful introduction. And good evening and welcome to all the participants. So I will start my screen sharing just to talk verbally for 1 minute prior to sharing of the screen. In today's world, the impact of global developments is all the more relevant, all the more impactful because of, tariffs. So now, on the lighter side, this word is gaining ground, tariffied. That is the English word tariff and tariffied. That's what's happening to the entire world. So that also is part of the coverage. But mind you, the intent of my coverage is whatever is happening all over the world and the impact on us as an economy, but not about a projection of the stock market thing. Like people may want to know, just to set the expectations correct, people may want to know what is the level of, say, S&P, Dow Jones, or NASDAQ, or other indices all over the world. What will be the impact on the market in India? So that is not part of the coverage. I will talk broadly about what's happening globally and broadly what's the impact on us here in India. So I will now share my screen. Is the screen visible?
Neha, yes, sir, it is visible.
Okay. So I now start the discussion. So you can see the first slide. Now here my perspective is not so much now, sometime earlier, there was a debate in media, in social media, about whether the Indian economy is coupled or less coupled with the global economy, or there is a decoupling happening. What is the meaning of this coupling or decoupling? It means that whatever is happening in the world, if there is a kind of one-to-one correspondence or one-to-one impact on us in India, that is coupling. And decoupling means if the impact is less than that, as in something happening globally, if the impact is, say, 70% or 50%, that is kind of decoupling, as in the impact in India is not as much. However, whenever those discussions were happening, that whether we are coupling more or coupling less with developments in the global economy, the point missed out in those debates was coupling or decoupling of what? So that is where I have broken this down. You can see the screen, the 3 points I have mentioned: economy, equity market returns, and instant reactional sentiments. So what is it? So on the economy, whatever happens in any part of the world, there is an impact, and in particular on India. So how that happens is impact on the economy happens with a lag effect. Why? Because we export. So if, as an example, if the global growth rate is lower than earlier, our exports will be impacted. Like if you look at historical periods like 2008, in 2008, that so-called global financial crisis. I'm saying so-called because it's actually a US financial crisis, but it could not be called US financial crisis because of reasons of political correctness. So it was called global financial crisis. So during that global financial crisis, our economy also was impacted, even though there was no issue in our financial structure, like our financial institutions. They were not impacted by those developments. Our markets are more well regulated by RBI and other institutions. Still, our economy was impacted, and the RBI had to cut interest rates severely. Why? Because our economy was impacted. And why was our economy impacted? Because our exports were lower. When the global growth is slowing down, our exports are lower. So when our exports are lower, our GDP growth also comes down. So if you recall those days, there was a slowdown in our growth rate. So about the economy, whatever is happening today, US, Trump, whatever they are doing, if and now it seems likely, if that leads to a global growth slowdown, then our economy also will be impacted, but with a lag effect, because it's not like instant reaction. It may be 3 months, 6 months, 9 months, whatever. So with a lag effect, economies all over the world will be impacted. I'll show you gradually uh, the impact. So if there is a global growth slowdown, if there is a full-blown trade war, and if global growth slows down because of that trade war, the economies that will be less impacted are ironically China, India, and US. Even though they are the main adversaries, US and China, uh, these economies, including us, India, we will be less impacted because of our relatively lesser dependence on exports, because we have a large domestic economy. So we'll discuss more of this gradually. So 3 things I've mentioned here: economy, equity market returns, and instant reaction and sentiments. So on equity market returns, psychologically, it seems that whatever is happening globally impacts our markets, and our markets move in a similar direction as global markets. However, that is a misnomer. And why that happens is, whatever happens globally, like US market or some other market, Chinese market, or whichever market is up or down, accordingly, our market also is up or down. So that leads to us psychologically thinking that our markets move in the same direction as markets in other parts of the world, which is not correct. I will show you some data. And the third point is instant reaction and sentiments. That is a fact because in today's age, internet, Google, media, social media, whatever happens in any part of the world is instantly, known to the rest of the world. Like, sometime earlier before the elections, there was one man hiding in Trump's garden with a gun. The moment that flashed in US media and US social media, within 1 second, it flashed here in India. So in India, we also came to know that something of this sort has happened. So today, anything happening anywhere, be it US, be it China, be it Europe, be it Japan, any part of the world, that data, that information flows instantly because we have internet, we have Google, and we have so many things. Now that makes us think that because of this reaction to what's happening globally, equity market performance, equity market returns also will be similar, which is not the case. So now let me show you some data. So on this, lot of data is hitting you. So take your time and absorb this. I've taken this because the source, NSE Market Pulse February issue. So what this shows is over the years, like 2015, 16, 17, 25, so small this thing, I mean, till February only, and 2024 we have the data. Over these years, which are the asset classes and what are the returns delivered by these various asset classes? So we'll take some examples. 2015, Bitcoin gave so much, 34% return. Stocks gave so much return. NASDAQ gave like 9.8%, S&P 9.4, S&P 500 1.4. So the point I'm making here is when you see, like, say, NASDAQ giving 9.8% return, or S&P 500 giving, say, 1.4% return in that year, our Nifty 500 gave 0.2% return, which is different from, say, Nasdaq. Come to 2016, like FTSE gave 19%, Dow Jones Industrial Average 16.5%, our Nifty 50 gave 4.4, and Nifty 500 gave 5.1%. So significantly different numbers, like FTSE giving 19.1, Dow Jones 16.5, and our Nifty 500 5.1, Nifty 50 4.4. Similarly, all these years, like 2017, Nifty 500 gave 37.7% return, Nifty 50 30.3% return, Dow Jones somewhat similar 28.1%, other indices like, say, FTSE 12% return. So all different, like 24 last year, Nasdaq 25.9, S&P 25%, Nifty 50 10.1%. So significantly different numbers. So I'll reiterate this point. Because of this instant market reaction, like in the morning before the markets open, people will look at how SGX Nifty. It used to be SGX Nifty earlier. Now it is GIFT Nifty. So that SGX Nifty or GIFT Nifty, how it is open, like plus or minus, plus 100, minus 100. People look at that, and that does have a bearing on the opening level of our markets, our Nifty, our Sensex. But as we are discussing, the returns over 1 year is not the same, maybe somewhat similar, or maybe even significantly different. So that is my point I made here. Equity market returns are not exactly linked as the economy or, say, instant market reactions. Economy is linked, is coupled with the global economy, but with a lag effect. Instant reaction happens within 1 second, and equity market returns. Maybe instantly, markets are moving in the same direction as the global thing, but over a longish period, like, say, like we're seeing 1 year time periods, returns are different. So same thing from a different perspective. So look at this. You can see the date, you can see the source. Source is Mint. It came out 28 February. So over this period, 27 September 24. So before our market correction started, our market correction started from October 24. So the peak which happened towards end of September 24 and till February, till 26 February 25. So this time period, this does not cover the latest correction that happened in US and other markets over the last 1 or 2 weeks, but still you'll get the essence of this thing. So over this 5-month period, October, November, December, January, February, over this 5-month period, and this is market cap. I'll show you index movement also, but market cap gives you an overall picture. So look at the market cap movement, top 10 countries, $1 trillion over 5 months from October to February. So US market cap was so much, September, it went up. Till February, US market cap went up. China also, market cap went up. It was here, it was here. In Japan, it went down a little bit. Hong Kong was up a little bit. So look at this India. India was like approximately $5 trillion as on September, end of September 24. Now as in 26 February, it was like $3.9 trillion. So our market cap came down. So like the example we discussed earlier, over years, equity market performance can be different or are different. So here we see last 5 months, US market cap went up and our market cap came down. Reasons broadly aware, FII selling, growth slowdown, or EPS growth was not growing at the same pace, and valuation issues, all those things cropped up. Other markets kind of remained similar, like UK, Canada, France kind of remained similar. So I will now show you index movement over this period. So look at this is S&P 500. So S&P 500 on 30th September, it was 5762, and 28th February, it was 5954. So it was up from 5762 to 5954. You can see this green colored curve. Then Shanghai Composite, it was 3327 September 24, and now it is 3321. So similar, maybe a little lower. Japan Nikkei, so Nikkei was 37,924, and now as in February, it is 37,156. So Nikkei came down. Japan equity market came down, and our Nifty. So by now it is well known. So Nifty was 25,810. And now it is 22,124. Now as in 28th, not the latest, but 28th February, same time period I've taken. What it means is over the same time period, last 5 months or last 6 months, we see diverse movements. US S&P 500 went up. Shanghai was little lower, broadly similar level. Japan Nikkei was down, and our Nifty was down over the same time period. That's about the equity market differential movement. Now I come to the crux of the coverage, what's happening globally, and then ultimately come to what is the impact on us in India. So what is happening in India today, sorry, in the US today, or what US Trump, what they are doing is broadly known to you. I will give you the broad historical background to this thing. Long time back, there was a global agreement called GATT, as it was called, that is Global Agreement on Tariffs and Trade. And the understanding there was that developing economies like India, we are a developing economy, we can impose tariffs on imports from developed countries because we need to protect our industry. Our industry is nascent. So we can impose tariffs on imports from developed countries. Whereas developed countries, they being developed, they will not impose that much of tariff on imports from developing countries. So this thing GATT, that is a Global Agreement on Tariffs and Trade, gradually became WTO, that is World Trade Organization. So what is happening today, the US, they are going against the understanding of the WTO, that is World Trade Organization. What they are saying is that whichever country you are, developed or developing, we will impose reciprocal tariffs, meaning when US exports to that country, whatever like 10, 20, 30%, whatever 10, 20, 30% tariffs are imposed, if so far till today, if US is imposing a lower tariff, they will not do that. They will impose a similar or relatively higher tariff on imports from those countries. So what's happening today? Like so far, they have taken on Canada, Mexico, China, and talking about reciprocal tariffs on India. Also, not so far. Maybe someday he will take on us also. So basically, what they're saying that US exports to India, if tariff is say 10% or whatever percent, and Indian exports to US, if it is say 3% as an example, that will not be okay with them and they will impose a higher tariff or whatever to whatever extent. And they are putting pressure on us for lowering the import tariffs on exports from US to India. Like some alcohol brands have already reduced. Apparently, they want zero tariff on auto. It is cars exported from US to India. They want zero tariff on that, apparently, as per social media. So net, they are going against the understanding of the WTO. Now, one basic theory of economics is that, that theory of relative efficiency. I can do this better than you. I can do this more efficiently. I can do this at a lower cost. So I will do that. I will do that more efficiently at a lower cost. And you can do that better than me, more efficiently and lower cost. So I do this, you do that. And then we will exchange, which is called trade. So that is one essential rule of economics, that people will do whatever they are better at and then trade, and they will thereby exchange their efficiencies. Now, what the US is doing today is that they will not do that. Now, what Trump is saying, America first. America first sounds good. It is good for them. But ultimately, it is not good for the global economy as a whole. Now, when Trump says this, or US does something like impose tariffs and all these things, to give you the background of the USA, the economic fundamental strength of the USA is not good. Why? They have a big what is called twin deficit. Twin deficit as in budget, it is financial fiscal deficit, and trade as current account. So they have a big current account deficit and they have a big fiscal deficit. And any other country with so much of fiscal deficit and so much of current account deficit, they would have collapsed by now. The US, they are surviving. Why? Because they are the reserve currency of the world. Now, any country or any currency being the reserve currency of the world, what does it mean? It means my problem is your problem. If something happens to US and something happens to the currency, that becomes the problem of the other parts of the world. That is how they have been surviving. Now the question is, yes, today USD is the reserve currency of the world and they will remain the reserve currency over the next whatever, 10, 20, 30, 40 years or whatever. But will US or US dollar remain the reserve currency forever? The answer is no. So I'll show you something. I've taken this from Google. If it is not very readable, it's okay. I will tell you verbally. So this shows the history of last 700 years. If you can read my screen, this is 1400. So 1400, 1500 till today, 2000 or 2100, whatever. Over the last 700 years, this shows the history of the reserve currency of the world. So you can see here, Portugal, Spain, Netherlands, France, Britain. So Britain ruled us for 200 years and now USA. Now this shows the life of the reserve currency. Like Portugal, they were the reserve currency for this time, like 1300 or whatever, till like 1500 or something, 15 something. Portugal, they were the reserve currency of the world. Then it was Spain. Spain was reserve currency over this time period. Then Netherlands, Dutch, they were the reserve currency. Then France, they were dominant. Then Britain, they ruled half or most of the world. And now USA. Now the point here is, if you look at this, no currency remained the reserve currency of the world forever. So can US dollar remain the reserve currency of the world forever? Answer is unlikely. So today they are, and in the foreseeable future, like next 10 to 30 years, also they will remain the reserve currency. Why? Something called TINA factor. TINA means there is no alternative. In the sense, if not US dollar, what else? There is no viable alternative that can stand up and say that if not USD, so and so is the reserve currency of the world. So euro, when they started like 30 years ago, nobody said it so many words, but they must be having a thought back of their mind that so many countries, Germany, France, and so many countries, we are getting together, we will become strong and we will rival the US dollar. But that was not to be. Europe, they're not getting the growth, they're not as strong as they were expected at some point of time. The GFC happened, countries like Greece, Italy, they were kind of bailed out by the stronger countries like Germany and France and all that. Euro is not really a rival. China, yes, as a country, they are strong, they are growing, and their size is big, next to or similar to the USA. But the way China behaves globally, nobody likes them. Like Corona, you know it. It started there and they spread Corona to the entire world. The way they try to capture, soft capture certain countries, people don't like it. And there's a saying that about China, even their friend countries don't trust them. So China is not there. India, good country, but we are small as of today. In the global picture, we're like approximately 4% or less than 4% of the global GDP. So someday maybe, but as of now, we are small. So there is no viable alternative. So as of now, USD continues as the global reserve currency. Now, when country or one currency is the reserve currency of the world, there is an implied this thing, two things. One is they will share the GDP with the world and they will provide protection to the other part of the world as and when required. Now, when I say share GDP with the world, it does not mean charity. It means trade, that people will trade and people will share their efficiencies with other parts of the world. And protection means the reserve country, reserve currency, they will have a strong army. So when some other country requires that protection, they will provide that. So what Trump is doing today, in a way it is good, in a way it is bad. Good in the sense so far, anything happening anywhere in the world, they would interfere and they would dictate terms. Today, when Trump is withdrawing from, say, Ukraine, in a way it is good. They're not doing that bossing over of that country. In a way, bad because these global tensions, one-to-one tensions, will be on the higher side. So now the thing is, when US is withdrawing and when they are not kind of supporting some other country like Europe, Trump said that Europe cannot outsource their defense with us because we are spending money on their defense. Means they are kind of withdrawing from their moral responsibility of provide protection because of the reserve currency. At least to allies, they should provide protection. They are withdrawing from that. And I'll show you something about some data about the relative position of the US dollar. To see this, total US debt, $36 trillion, of which 1 trillion was added in the last 100 days. It may not mean much to you. So what is this $36 trillion and what is this $1 trillion? To give you a perspective, or let me show you the next slide first, then I'll come back to this. This is US debt as a percentage of their GDP. So look at this. This curve is going up. And just recall what time period is this, 1941. This time period is after the Second World War. So after the Second World War, you know how their economy, what happens to the economy. So when the economy was in trouble, they had to pump up, the government had to spend more and deficit went up, their debt went up. So US debt as a percent of the GDP went up here, like maybe 170, 118%. And since then, they recovered. 1980, 1981, it was here. Now look at this from here to here, current period. Their debt as a percentage of their GDP has gone up so much. So today's level is the highest ever since the, or even higher than the Second World War. Post Second World War, when economy was challenged, they pumped up debt. It was here. Today it is even higher. So there is a saying that the country has been there for like whatever, 200, 250 or whatever number of years. Whatever currencies they are in circulation today, 35 to 40% of that was created post-COVID. 2020, all countries all over the world, they pumped up their deficit, pumped in money. And even after that, so the extent of money they have pumped in, 35 to 40% of the currency which has been created in the US has been created 2020 onwards. That gives you a picture. So now here you get the picture that $36 trillion. So it is like whatever extent of debt they had, like say 10 years ago, and the rate at which they are piling up debt today. So like here you see the last 1 trillion was done in 100 days, whereas the previous 35 trillion happened over the last say 250 years or so. That gives you a pace. Now, what is the point here? The point here is when they are piling up so much of debt, they are assuming that they will remain the reserve currency of the world. They will be able to make their problem, the problem of the rest of the world forever, which may not be the case, which means they are gradually going into trouble. When, I don't know, 10 years from now, 50 years from now, I don't know, but gradually they are going into trouble. Now, after this, when I show you the extent of pumping up their debt, you can see how this curve is going up, and this percentage GDP, how this is going up. Now look at this. When they are issuing so much of debt, like here we have government securities, there we have US treasuries, UST as it is called. Who buys US treasuries? Of course, people in the US, institutions in the USA. Apart from institutions in the USA, so look at this here in this pie chart. The dark blue is domestic as in US, and this light blue is foreign. 1970, 95% was domestic, 5% was foreign. 95, 77% domestic, 23% foreign. 23, 71% domestic, 29% foreign. What it means is over the years, their dependence on foreign sources for funding their debt is going up from 5% to 29%. Their dependence on foreign sources are going up, which means not only people or institutions in the US, but so basically it is sovereign countries, like whichever country, non-US country, they buy US treasuries, and their reliance on that non-US buyers of debt has gone up over the years. Now coming to this, when we say other countries means what? The two largest holders of US treasuries are China and Japan. Then we have so many other, like maybe 100 other countries, because US being US, so many countries buy their government, that is US treasuries. What is happening is last 1 or 2 years, China has been selling US treasuries. So what does China do? China have so much of surplus, trade surplus with the US. So the trade surplus which China generates from trading with the US, what do they do? That surplus, they again invest in US treasuries. So they have this surplus by trading with the US, and they have the investment also with the US. And why is it shifting? Over the last 1 or 2 years, China has been actually selling US treasury. They are not buying incrementally, they are selling US treasury. So what was the trigger? Just recall 22 what happened. In 22, you all know the Russia-Ukraine war happened. And after the Russia-Ukraine war started, they as in US and Europe, they imposed sanctions on Russia. And at that point of time, when they imposed sanctions on Russia, one is that, US or whichever country, the committee of countries, they threw they threw Russia out of SWIFT. SWIFT means that banking system, that banking transaction system, that global thing. They threw Russia out of SWIFT. So Russia was out of the banking system of the world, and US forfeited Russian money. They wanted to show Russia as a defaulter, and they forfeited Russian money. So what does it mean? So whatever China, whatever Russia did was bad in the sense war and all those things, whatever we call it. But the point is, Russia is a sovereign country, and one sovereign country forfeiting the money of another sovereign country is a global no. Sovereign, you cannot do that. So the entire world took note of that. There was no statement, but the entire world took note of that. And they thought that today, if one country, that is US, can forfeit the money of another country, that is Russia, tomorrow they can do that to some other country also. It could be China, it could be India, it could be some Madagascar, Honolulu, whatever. There is a danger. So China started selling US treasuries. Over the last 1 or 2 years, China has been actually selling US treasuries. They are not buying. Now equate the two. US, they're piling up debt. And when they're piling up debt, the government issues US treasuries. And who buys? Apart from people in the USA, other countries, maybe 100 other countries, but the biggest holder of US Treasury is China, and China at the margin, so they cannot change overnight because they have so huge holding of US Treasuries. But at the margin, they are selling off, which means trouble for the country. Now coming to US dollar being the reserve currency of the world and global transactions, look at this. US dollar is still dominant, and this gives you a picture of how dominant the US dollar is. So this dark blue thing is US, this orange color is Europe, and then this grayish is UK, and then Japan is this yellow kind of color. So forex reserves, you can see here almost 60% of forex reserves is in US dollar. International debt denomination is mostly in US dollar. International loans mostly in US dollar. Europe is kind of there, but not really, whatever extent not competing with the US dollar. So forex transactions, yes, maybe 90% in US dollar. Now look at this international payments and trade invoices. So look at this trade invoices. Intuitively, even I thought earlier, most of global trade invoicing happens in US dollar, but look at this data. Approximately 50% of whatever number, 50, 55 or whatever percentage. So only this much of global trade invoicing happens in US dollar, which means for global trade, US dollar is not the only currency. It may happen in other currencies also. So like we discussed earlier, if US does not remain the global reserve currency, and there is TINA as in there is no alternative, then which one? There is no clear answer, but we may see increased unilateral transactions, like whatever India and Russia are doing. India buying oil from Russia, be it Indian rupees or be it ruble, Russian ruble. The thing is, it is some other country, some other currency other than US dollar. So today, if India and Russia can trade in, say, ruble or Indian rupee or whatever, tomorrow some other country can do it, which means US dollar is not the only currency for global trade invoicing. It may be unilateral. Like if you have heard of this thing, sometime earlier, one country, if I recall correctly, Argentina, they were settling some debt to some other country like China. Usually it happened earlier, it happened in terms of USD. That happened in some other country, and that settlement of thing happened through IMF or World Bank or something, or sometime earlier. So Saudi Arabia, supposedly an ally of the US, they had a 50-year-old agreement that their trade will be denominated in US dollar. Their basically their crude oil trade. That agreement became due for renewal, and they did not renew that agreement, and they supposedly an ally of the US. So this unilateral stuff is happening, and that may be called the beginning of the end of US dollar. Some more data about the relative position of US in the global this thing. So here we see change from 2014 to 2024. So when global trade, so US share of global trade over these years, like 2014 to 2024, it went up by 0.7%. So approximately whatever 11.3% of global trade is the US share. So if global trade is say 100, US share is 11.3%. Global GDP, US is the dominant. Over these years, 2014 to 2024, it has gone up by 3.3 percentage points. So US has 26.5% of global GDP, which is big. But also because look at it this way, there is no major rival. China is the only rival in terms of size or growth rate. India, we are growing fastest, but we are, as of now, we are small, less than 4% of global GDP. We are not really rivaling. European countries, no major growth, so there's no real rival. So today, US has 26.5% of global GDP, and it has grown by 3.3 percentage points from 2014 to 2024. Swift payment, it has gone up by so much, 2.9 percentage points and half. But also look at this thing, Swift payment, it is not only in USD. 47.9 means basically less than 50%. Less than 50% of Swift payments happened in US dollar. There are other currencies also, be it Euro, be it GBP, whatever. Forex is up 58.2%, so it is not 100, it is 58.2%. And Forex transaction, yes, it is 90% is in US dollar. Now come to the but portion. Dollar still dominant, but. So look at this, dollar's share of global reserves has declined gradually. So look at this thing. Dollar's share of global reserve, this thing, was like 70 plus percentage in 2000. Now it is here, so approximately 60%. So other countries, so now after this thing happened, US forfeiting Russian money and whatever they're doing to other parts of the world, their share has been coming down, and you can see here. So what is going up? This others like this light blue, others is going up, and euro yen is kind of slightly upward, but not so much. So basically, non-USD currencies. People, as in governments in other parts of the world, prefer to gradually move away from US dollar. We, India, yes, we are investing in gold also. We are investing in US dollar also because not too many alternatives. But you would have heard this thing that sometime earlier, India, our RBI, they brought back some gold from London. Official word is different. Official word is that we had to pay rent or whatever. The point is, whatever is happening globally, if something escalates, something blows up, why leave our gold in London? And sometime earlier, so it was very this thing prominent on social media. It said that gold reserves with the Bank of England or gold deposits kept with the Bank of England, that has been reducing significantly. And who is it? So who is taking it away? There was no official word, but social media said it is US. So what India did, whatever gold deposits US Fed or US government has in the Bank of England at London, their coffers, they are taking it away like India did. And what is the reason? Again, no official word, but social media said that Trump would like to revalue their gold reserves. So the valuation at which they are valuing their gold reserves in the US is like very low, maybe like $50 or something. Now, the price is much higher, like $3,000 or whatever. So they want to revalue and book those profits. So net, globally, things are happening and people are less reliant on others. And look at this, similar data, but in a better optical manner. Dollar still dominant, but so global exchange reserve, you can see here, it is 58% in USD. It is not 100, it is not 90, it is only 58% in USD. Like you can see here, 20% euro, 5% GBP, 6% yen, and all that. And share of export invoicing, it is 48%, which means intuitively, even I thought earlier that would be like 80-90% in USD, but it is not 89, it is 58 or 48% in USD. So USD is not the only alternative to the world. Okay. The topic is global. US is one part of the globe, not the only part of the globe. Now we come to other aspects. My next point is population. So look at this thing. I'm showing you some data. So look at the screen, absorb this thing. You can see the source about McKinsey report, which came in Jan 25. So this shows the projection of population over the next 75 years or so, 2100. So 2025 and 2100, maybe next 75 years or so. And they have projected the population. So digest these numbers. Look at us, India. Currently, our population like 140, 145 crore or something. Projection is our population will grow at 5% over these years, 75 years or so, and it will become 150 crore. So like today's 140, 142 crore or whatever will become 150 crore over the next 75 years. Now look at this, China. As per their projection, population will shrink 55%, but less than half. It will shrink 55% over next 75 years. It will become 63 crore. Look at these countries, Italy, they will shrink. Japan, they will shrink so much. Germany, they will shrink. Only countries to grow population will be US, UK, and France. So these countries, they will shrink their population. Even developing economies like Turkey, Brazil, they also will shrink their population. And look at these numbers. If our population becomes 150 crore after 75 years, which is the nearest rival, nearest comparison, nothing nearby. India, 150 crore, 2100. China, 63 crore, and that's about it. Nigeria, 47, 48 crore. Indonesia, 29, 30 crore. So in terms of population, there will be no country comparable to India. Today, India, we have the highest working age population. And with growth of population, we'll have more working age population, which will propel the country forward. And the theory is that going forward, countries will import population from India in the sense, okay, not US, they are raising the whatever issues, take back illegal immigrants and all those things, may not be US, but other countries like you can see here, these countries like Japan. Japan already is an old population and it will shrink further. So some countries may actually require and they may actually import population from India for their working age thing. This is positive for India because today we have the highest working age population and with growth, we will have more working age population. And what I said about this, other countries importing population from India sometime in future, I'll show you one stark example. So a lot of text here. So just read this text. I'm talking about South Korea. So officially, South Korea is a super aged society. So what does it mean? 1 in 5 people is 65 or older. So as per UN classification, it says that more than 7% of population, 65 or older is aging, and more than 14% aged society is super aged, and 20% is super aged. So in South Korea today, they say there are more grandmas and grandpas than grandkids. So more countries going forward will face this issue, which is a positive for India because our population will grow. My next point, because it is global, not just US, fragmentation. This is the source, World Economic Forum. It happened in January this year. See the source here, Jan 25, World Economic Forum. This thing, they published this thing. And what is this fragmentation? So read the text, take your time and read the text. Global financial system fragmentation refers to the increasing disintegration of the interconnected global financial landscape into distinct blocks. Fragmentation arises from geopolitical tensions, regulatory divergence, and the emergence of regional financial systems that operate independently of one another. So forget the complicated text, just look at this number. What they're saying is output loss from this global fragmentation. So 0.6 trillion to 5.7 trillion, or about 5% of global GDP in the short term. And this is the most significant line here, though it is not in bold. By comparison, the COVID-19 pandemic caused global output losses of approximately 2.5%, and this is significant. So this source, this World Economic Forum, what they're saying is because of COVID, whatever extent we lost a global output, which is 2.5% or whatever, here they're saying 5%. So basically they are saying whatever we lost due to COVID, we will lose double of that because of fragmentation. Fragmentation was happening any which way, and whatever Trump has been doing since the last, say, 1.5 months or so, he is increasing that fragmentation. So this is not good for global growth. So one of the corollaries of US withdrawing from countries is the increasing geopolitical risk. So whatever the US did earlier, whatever is happening any part of the world, like be it Vietnam or be it Iraq, they will interfere, they will dominate. In a way, it is bad. They are playing boss over other countries. But in a way, it's like this, that when the big boss withdraws, there will be more of one-to-one wars, like Middle East. Countries are fighting with each other. If there is no big boss over them, they will keep on fighting. Today, if China attacks Taiwan, whatever they did on the basis of support from US, now things have changed. Today, if China attacks Taiwan, I don't know who will come to save Taiwan. Ukraine, whatever they will do. If there's no one to support Ukraine, and if Russia attacks again, whatever ceasefire is there now, if Russia attacks again. So basically, one-to-one tensions will be higher in the world. So you can see this, I've taken this from RBI bulletin. So PRI is political risk index. So the blue one is India on the right-hand scale. So it is not same because scale is different. Here you see 0.2, 0.4, and here you see 246. So global risk is much higher, Indian risk is much lower. But yes, you can see all these events. Whenever the events happen, like Gulf War, Iraq War, Russia, Ukraine, geopolitical risk goes up. So you can see here the categories of geopolitical risk. One is outright war, like Russia, Ukraine, or whatever. Military build-up, like one country threatening another country, and terror threats, like we also face this terror threats. Now there is a global reset happening. Look at this headline. It came in Financial Times on 17th of February. Now, so far, Trump is right in saying that, so far Europe was outsourcing their defense to us. Why should we spend our budget for defending Europe? Yes. And now they are into a huddle. What will happen now as in Ukraine, Russia war and all those things? So if US is not helping their allies in the Europe, they have to fend for themselves, which means good, bad, whatever, we can debate that. Global change is happening, a global reset is happening, and that is the situation we are in now. In the context of global trade, like I said initially, that the basic economic theory, I can do this better than you can do that better than me, and we'll trade. That trade is impacted. So this shows global trade as a percentage of global GDP. Now look at this, 1940 something. From here, it has been going up. It went up here. Now from here, this GFC, global financial crisis, it dipped here. Then COVID happened, 2020, of course, COVID, global trade was low. Now the point is, you see here, towards the right, if you can see my cursor. Post-COVID, while global trade recovered, so global trade as a percentage of global GDP, it was still lower than the earlier peak. So earlier peak was here, So post-COVID, even after post-COVID recovery, the extent is lower. Then it shrank, and now that Trump has taken over, global trade will shrink further, and that is a thing. Okay. Now coming to the next big country, China. To give you a perspective on the size of China, in terms of GDP, they are next to USA, and in terms of PPP, that is purchasing power parity, China is already bigger than USA, and that is big. In terms of purchasing power parity, China is already bigger than USA. However, having said that, whatever growth numbers we see about China, that economy going at say 4.5% or 5%, there is a question mark about their growth rate. You can see here around 5-ish% is their GDP growth rate. Now, again, what we learned in college in economics is that for a growing economy, there should be some traction, as in there should be some inflation. So whatever, 1%, 2%, 3%. If inflation is say 8, 9, 10%, it is high, it is bad. But some inflation, like say whatever, 1 or 2% is good because it shows some traction. Now look at this. China actually faced deflation earlier. You can see a minus 0.3, minus 0.8. Now they have some inflation, like how much? 0.1%, 0.2%. So to me, it's a question that if a country is really going at say 4.5, 5%, the economy must be having some traction, but that some traction is not there. The inflation is so low, 0.1%, 0.2%, whatever. And the way they're managing, like so much of stimulus, real estate sector in China is in trouble, and they pumped in so much of money to at least keep the real estate sector alive. They have so much of ghost cities, ghost towns, their railway network not having passengers commuting and all those things. So even amidst so much of this thing, how they are managing or reporting 4.5% growth rate, I don't know, maybe a case of Chinese data. But yes, in terms of size, they're much bigger than us. And when I say within quote Chinese data, I'll give you some examples. So lots of data here, you can just look at this thing. You can see the source here, Axis Bank report. So what Axis Bank report says is, why is China's external balance sheet weak despite surpluses? Look at this thing. 10-year change in international investment position and BOP components. So current account surplus was so much, $2.5 trillion US dollar, 2.5 trillion. Change in net investment position is only half of that, 1.4. And 1.4, that is half of that, what is called errors and omissions, which in, to put it in simple Hindi, whatever current account surplus they had over this 10-year period, uska aadha gaib ho gaya. No one knows where it went. Do they really have that much of surplus which they reported? I don't know. So what this report says is basically, they also don't know, and that is the point that is being made. To look at some more data. Net in international assets relative to GDP. So look at these countries. These countries have trade surplus like Taiwan, Japan, Germany. Now they don't have, but earlier they had a trade surplus. Countries with trade surplus, international investment position, percentage of GDP, China is only here. Taiwan is so much higher. Other data points like change in international investment position, IIP, as a cumulative current account surplus, China is somewhere here in the middle. You can see other things like investment income as a percentage of assets. You can see here, China is not on the higher side. And look at this, investment payment, percentage of liabilities is higher on China. So if they really have so much of surplus, why are they reporting these kind of numbers? Any which way, whatever growth they're reporting, maybe a bit of dilution is there. Now coming to currency, our currency and this thing and all that. Now in the context of currency, our like 87, 86, 88, whatever number, how is it expressed? How many Indian rupees we require to buy one US dollar? So our currency is denominated to the US dollar. We have to give 86 of our currency or 88 or 87 of our currency. However, US dollar being the reserve currency of the world, it can't be only one currency. So like strength or weakness of US dollar is not against some INR or similar currency. It is a basket of currencies you can see here. It is called DXY or DXY or whatever. You can take this from Wikipedia. So DXY, it's called DXY because on Bloomberg screen, if you type DXY, you get that data. That's why the market calls it DXY. So this dollar index DXY is a basket of currencies you can see here. 6 currencies with weightage is defined, like euro, like 57-58% weightage, euro, yen, pound, dollar, Swedish krona, Swiss franc. And you see Chinese yuan is conspicuous by absence. They are not there. The way they have behaved globally, no country likes them. And even though the country is big, global trade and all that, so they are not part of this. So the strength or weakness of DXY or the US dollar is measured against these currencies, a basket, defined basket of with weightages of like euro so much, yen, pound sterling, and all that. So look at this. When DXY strengthens, our currency weakens. So our currency, like rupee, is it like 80 rupees per US dollar or 90 rupees per US dollar? So when DXY strengthens, like you can see here, from October till here, 110, DXY went up to 110. Our currency weakened. And from here to here, now it is like 105 or 106 or something. It is even lower from what I'm showing you here. Of late, yes, DXY is not strengthening, which is good for our currency. Our currency is kind of stable now. Now, over this period of time, from October to January, when DXY was strengthening and INR was weakening, we had significant RBI intervention in the market. Why? RBI is not comfortable with the sudden or volatile weakening of our currency. So RBI supplied USD, which takes away rupee liquidity from the banking system. And there was significant extent of RBI intervention. So in this phase, when DXY strengthened, DXY strengthened means other currencies weakening. As a measure, you have these currencies like euro, yen, pound, whatever. Other currencies and also currencies they're not part of the basket, like Asian currencies or maybe Brazilian real or other Asian currencies, they also were weakening in that phase. So look at this comparative data. So I've taken this from Mint 17 Jan, and this is, you can see the time period here. 1st Jan 24 to 16 Jan 25, so approximately 1 year. Over this approximately 1 year period, Brazilian real, they lost like 17, 18%. Mexico, they lost so much. Turkish lira, they lost so much. All these countries, Russia, South Korea, they lost so much. And India, we lost like approximately 4.5%. So we lost less than other currencies. Could be fundamental strength and largely due to RBI intervention. So RBI supplied USD and took liquidity away from the system. And that also contributed to our currency weakening less than other currencies. So I have some more data. So this is still 16th of January, and this is till 11th of February. So till 11th of February, level 1 year ago, and current level, current means 11th February 25, and movement over 1 year. So over this 1 year, you can see here Argentina. Argentina lost 27%, Mexico lost 20%, Turkey lost 17% and all that. India, we lost 4.6%. China, they lost less, only 1.5%. And some countries like Chile, South Africa, Malaysia, they gained. But net, India, we lost relatively less than other currencies, like you can see here. So I'm almost towards the end of my PPT. I'll show you the last slide of my presentation. I started by saying that we will discuss whatever is happening globally, what will be the impact on us in India. And I said our impact will be less. Why? Don't get me wrong, impact on India will be there. If a global trade war happens, no country will be unscathed. Impact will be there in all countries. What I'm saying is that impact on us in India will be relatively lower. And why so? Why relatively lower? So look at this graph, and this is important data. So this shows that dependence on trade. So this is exports plus imports. So this is 100%. For some countries, it's more than 100% because it is adding exports and imports. So both are added. So exports plus imports as a percentage of GDP. Look at these countries: Vietnam, Netherlands, Malaysia, Thailand, Taiwan. They have so much of dependence on external trade, which means if the global economy slows down, exports are impacted. These countries will be impacted so much more. These countries, like you can see here: Vietnam, Netherlands, Malaysia, Thailand, Taiwan, Poland, South Korea, Germany. They have a higher dependence on the external sector. In other words, their domestic economy is there, but not as large. Now look at the extreme right. Today, whatever is happening globally, precursor to a global trade war, tariffs and counter tariffs and all these things, you see, US, their dependence on global trade is only so much. So in a way, it sounds bad to say, but they are kind of playing, whatever word you put to it. They are playing this thing to the entire world. But if something happens, the impact on US also will be there, but not as much. But net, whatever they're doing is not good for them. In the sense, today, to whatever extent, Canada or Mexico or China, they are putting reciprocal tariffs. Like there was a news the other day that in the US, automobile manufacturers are representing to the government that their cost of imports is going up significantly. So whatever they're importing, if some other country can produce those items, those inputs better or at a lower cost, if they don't import or if they impose tariffs, the cost goes up. So cost going up is ultimately not good for any country. But net, yes, they can afford to do it. Look at us, India. We have a large domestic economy, and that is why I'm saying impact on us will be less. Come to China. Today, the main adversaries in this global trade war are basically two countries, US and China. And look at this, they will be relatively less impacted. India also, thankfully. And the impact will be more on other countries in other parts of the world. So that is about my PPT. So before we go for Q&A, just to make a summary of what I am saying. So over the years, we saw that global trade as a percentage of GDP has been going up, but today it is less than the peak. So peak happened like say about 10 years ago. COVID obviously it shrank, and post-COVID recovery also it happened, but it was yet to hit that peak, and today it will come down further because of whatever tariffs and all these things are happening. On the interlinkages, if global growth slows down, so to give you some number, as per IMF in 25 and 26 calendar year, growth will be 3.3%. Now, 3.3% is not bad because India, we grew at like 6, 7, 8%. Globally, 3.3% is not bad. But the point is this 3.3% is the global average. That includes relatively faster growing countries like India and China. And in USA, whatever growth rate they're assuming, like 2.7%, 2.1%, they are projecting, IMF projections for 25 and 26, that may shrink now. Whatever they're doing is not good for them. Europe, even the leading countries like Germany, France, whichever countries there, their growth rate is not as much, less than 1% or whatever. Europe not really growing. So global growth being impacted will impact us, but not so much. And on the interlinkages, because of this internet and Google and all those things and social media and whatnot, we have an instant reaction to whatever is happening in any part of the world. However, if you look at, say, even 1 year time periods, the returns delivered by the stock market are different. Stock market in, so as an example, if stock market in, say, US or China or Europe, wherever, if that market gives 10%, our Nifty or our Sensex may not give 10%, can be something completely different. Or if the global market gives like, say, minus 10%, our Nifty or our Sensex can give something completely different. Like what happened in the last 5 months or so, if you forget the last 1 or 2 weeks, US market went up, our market went down. Reasons you know it, FPI sell-off, concerns on our growth, our EPS growth rate being lower than earlier, and all those things are there. So linkages, yes, in a way it is there, but don't draw a one-to-one correspondence about happenings in the global this thing and our country. On the interest rate movement, as of now, the view is that US Fed, they have cut rates by 1 percentage point, 50 basis, 25 basis, 25 basis, 1 percentage point. And now the probability of rate cut by the USA is even higher than earlier. I'll stop sharing this and I'll just complete this point verbally. Today, in the US, what they're saying is that inflation will be even higher. Whatever Trump is doing is not good for them. So their inflation will be even higher. In spite of that, the market is saying now there is a higher probability of US inflation going up, but US Fed will cut rates because their growth is a question mark. Whatever Trump is doing, he's not realizing now, but their growth will be a question mark, so they will have to cut rates. In the Eurozone, they will continue cutting rates because they're not really getting growth. Their inflation is kind of under control. China has been cutting rates for quite some time now. China cut rates before COVID, during COVID, after COVID. They have been cutting rates. So all over the world except Japan, they are cutting rates. Japan, what they're doing is, sorry. So apparently, yes, Japan has been hiking rates, but actually they are in a way normalizing. Normalizing means their interest rate was, overnight rate was minus 0.1% earlier. From minus 0.1% to plus 0.5%, they are kind of normalizing rates. In a way, hiking, but not really hiking, they're normalizing rates. So except Japan, look at any country all over the world, your US, Eurozone, China, Canada, Switzerland, Sweden, Australia, countries all over the world are cutting rates. We, India, RBI, we have started. So 7th February, RBI cut rates by 25 basis points. Next meeting is in April, 7th to 9th of April. They may cut rates, April or later, June or whatever. So RBI will continue cutting rates. So with that, I will pause here and now we will come to questions. Yes, Neha, you're saying something?
No,
Or if you have any choice of questions?
sir, questions are in Q&A board.
Right, right. I can see the board. Yeah, sure.
Yes, sir.
Okay, then okay, what is tariff? So tariff is like this. In a way, it is a tax or whatever you call it. It is like this. US exports certain item to India, be it a car or be it alcohol or be it chemicals or fertilizer, whatever the item is. US is importing some car to India. Sorry, US is exporting to India and we are importing it. So as of today, if India says on that we are imposing 50% tariffs, which means if the price is say 100, the price becomes 150 for the buyer in India. So basically, what India is doing is disincentivizing imports from USA because we want to promote our country, our industry. So if tariff is low or if tariff is say zero, and if that other country, if they can produce at a lower cost, in case they can do that thing, that will be cheaper. And if quality is better, people will buy that. So if that happens, our industry will not get promoted. So the government wants our industry to develop. So by imposing a tariff on imports from some other country in the world, government is promoting our industry. It's a debate whether the government should do this, should not do this. Anyway, not going to that debate. That is the concept of tariffs. That, or in the USA, what they're doing now, what they're saying is whatever the USA imports from say Canada or Mexico or China, they will impose a higher rate. As an example, today if the US is imposing say 5% or 10% rate of taxation tariff or whatever we call it, if that becomes 25%, means by virtue of that higher tax or tariff, it will become that much more expensive for the US consumer. So basically, Trump wants US consumers to consume less of imports from other countries, be it Mexico, be it Canada, or be it China. It's a theory that, because of this US-China trade or whatever, trade war or whatever you call it, China is routing their exports to USA via Mexico. So they have taken on together. Mexico also is part of this thing. In case they are routing, China is routing through Mexico. Okay. Uh, Quite a few questions on crypto. So crypto is this like this. So firstly, what is crypto? Supposedly a currency, but the point is, firstly, what is a currency? A currency is something which has a sanction of the government of the country. Like how here in India, our rupee is the legal tender currency issued by the Reserve Bank of India, or this CBDC, that is central bank digital currency. It is basically conventional currency rupees only. Only that CBDC does not have a physical existence. There's no physical currency note or something for CBDC, but basically it is RBI issued currency. However, this thing called cryptocurrency does not have the legal sanction of any country, any government anywhere in the world, except one small country called El Salvador. So you can forget the small country called El Salvador. Any reasonable large country, be it US, be it China, be it India, be it Germany, be it Japan, no government anywhere in the world has legal sanction for this as a medium of exchange. So cryptocurrency is growing through private acceptance. So private acceptance means what? If somebody is selling something, let's say Tesla selling cars, or let's say Starbucks selling coffee, if they say we will give you a car or we will give you coffee in exchange for crypto, may not be US dollar or Indian rupee or whatever, you give me crypto, I'll give you the car or I'll give you the coffee. So through private acceptance, crypto is expanding and it will expand even more because whatever is happening globally, all this fragmentation, today gold price is going up, fragmentation. So because of fragmentation, cryptocurrency value also is going up. But the point is, this crypto does not have the legal sanction of any government anywhere in the world. Okay. Hindi, no, I'm talking in English because I'm okay with Hindi, but there may be people from South India. That's why I'm not talking in Hindi. Can we go for the barter system? No. Ultimately, the issue is like this. Trump wants US or US consumers to import less from other countries. China, Mexico, Canada, India, Europe, whichever country. The same thing. Basically, he doesn't want that. And going back to barter system, see, barter can happen between, say, India and Russia. So if India tells Russia that we will buy crude oil from you and we'll give whatever item, whatever item, grain or whatever metal or whatever, we'll give you. That can happen. But US will not go to barter. If our population continues to grow and reaches so much, 150 crore, wouldn't have a negative impact in terms of resource availability and land usage. Land usage, my sense is slow. Because when we are traveling, be it a flight or be it a train, we see so much of land available. This land crunch in only say Bombay or Delhi or the metro cities, land crunch is there. If you go from India to Bharat, land is available. Other resources, so if you look at say agriculture, when we became independent, we had these various phases of famine post-independence. But today we have our grains rotting in those silos. We are self-sufficient in terms of grains. So the basics of life, food, grain, clothes, and all those things, we are now self-sufficient. So hopefully, and see, from 140, 144 to 150 crore is nothing much. Incremental is only so much. So my answer is yes. At 150 crore, we will have the resources like food, clothes, or whatever. And today we're even exporting certain things. Can BRICS nations kill dollar dominance? No. So you will know this thing that sometime earlier, this BRICS meeting was there in Russia, and all these BRICS countries that they say that this BRICS currency and all those things. And Trump gave a statement that if BRICS countries they go forward and go ahead with this launching of BRICS currency, we will do whatever. I'll impose 100% tariffs or some kind of threat he gave. And immediately our minister, Mr. Jaishankar, he said that it is not a priority. What does that mean? Trump saying if BRICS goes ahead with doing this thing and Jaishankar saying it's not a priority, basically it means is, okay, I'll put this in Hindi, he no panga with US. So tactfully tackle the US, don't take a direct panga with them, tackle this thing. So as of now, BRICS is not as big to float a currency and take on the dollar. No, if Euro can't do it, then BRICS cannot do it. What I foresee is one-to-one, like I said, India buying crude oil from Russia, denominated in either Indian rupees or Russian ruble or whatever, that is a unilateral thing, and that can happen. Which sectors will punish, I don't know. So, any question I missed?
Sorry to interrupt.
Huh,
Actually, we are running short of time, so we'll take only two next question from the Q&A board.
okay.
Any two question.
So, I think we are done. Why can't euro be used as a reserve currency? So, like I said, the basic assumption of reserve currency is that the country has to be large. The country has to have a dominant army to support other countries if required. And they have to be dominant in terms of the economy. Today, if you look at countries in Europe, Germany, France, and all, even they are not getting growth. They are doing well in terms of economy. So Eurozone, so firstly, what is Eurozone? It is a collection of so many countries, like 20 countries. It's a loose collection. It is not one country. That is one issue. And their growth is not as good. So they are not really as good as to challenge US dollar as the currency. So how US traffic's impact on Indian traffic or tariff? Yeah. So if they increase, so it is yet to happen. So the day US impose tariffs on India, we will see one more stock market crash that will hamper anyway. That will hamper our, but I think we can live with it. Like I showed you earlier, our dependence on external sector is relatively lower. So I think we can live with that. Last question, moves by USA can be said to be trying to control overall prices of all goods in the world. They may want to, but it is really difficult. See, certain things which you can command, which you dictate, yes. If you have so much of gold reserves, if you have so much of food reserves, yes, you can kind of control. Like say OPEC. OPEC, they have like only 35% of global crude, but they dictate terms because why? Because they are the larger exporters. They export so much, they can dictate. But US, whether they can dominate so much, I doubt. They can dominate, control the prices of everything. They can influence, yes, to an extent, but dictate terms, I'm not sure. So is it time, Neha?
Sir, actually, we are running
Okay,
short of time. So
sure.
I think we have discussed most of the important questions. So we should end the webinar here. So thank you so much all for joining today's webinar. And I would like to express my heartfelt gratitude to our esteemed speaker for sharing his expertise with us. A special thank to our audience for your participation and engagement. Just to remind for participant, you will get certificate within 3 to 4 days and the webinar recording will be available on NISM YouTube channel. So I officially close today's session. Stay connected with us for future webinar. Thank you. Have a
Thank
great
you.
evening.